Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Coming up on the show today, first, we'll dive into how the tiny AI startup Perplexity AI just made a stunning $34.5 billion public offer for Google's Chrome browser. Then, we're tracking the AI arms race in global supply chains, where spending is set to explode to $55 billion. And finally, the competition for Federal Reserve Chair is intensifying as the odds for a dark horse candidate suddenly surge while the frontrunner openly challenges current Fed policy. The story begins with a decision that caught everyone by surprise. A small AI startup just made a public offer to buy Google's Chrome browser for $34.5 billion. So the thing is, Perplexity AI is a much smaller company, which makes this offer a brilliant strategic move. It's part marketing stunt to get their name out there and part a signal to regulators that a viable buyer exists if they force a sale. They are, essentially trying to influence the entire conversation around Google's future. This isn't just some fantasy bid. It comes as the US Department of Justice is explicitly pushing for Google to sell off Chrome following a landmark ruling that the company holds a monopoly. Google's legal chief calls it unprecedented government overreach, but the battle lines are drawn, and this bid from Perplexity AI is pouring gasoline on the fire. The idea of selling off Chrome sounds simple, but it's actually incredibly complex. Chrome is deeply woven into Google's core services, like your user account sync, the safe browsing feature, and, of course, the ad infrastructure. Interestingly enough, experts at the Knight Georgetown Institute say it's technically feasible. They point out that other browsers run similar services, and the engineering talent exists to build a new independent foundation for Chrome. It would be a massive undertaking, but it is possible. But that's not the whole picture. The real turning point is how this potential breakup of the $2.5 trillion giant has analysts scrambling to put a price tag on its legendary assets. First, there's Chrome. While Perplexity offered $34.5 billion, analysts at Raymond James value it at $50 billion. Barclays warns that losing it would be a black swan risk, potentially wiping out up to 25% of Alphabet's stock value. Then there's Google Cloud. Analysts at DA Davidson have put a jaw-dropping valuation on it, $682 billion, calling it potentially one of the best standalone software stocks. And what about YouTube? The video platform Google bought for $1.65 billion is now called the new king of all media by MoffettNathanson, with a valuation as high as $550 billion, bigger than Netflix. After all, these businesses are deeply interconnected. YouTube, for example, relies heavily on Google's vast advertising platform and data analytics to generate its massive revenue. Separating them could damage the very synergies that make them so powerful and profitable in the first place. This has huge implications for the entire internet because Google is the primary developer of Chromium, the open source code that powers not just Chrome, but also Microsoft Edge, Opera, and many other browsers. Google currently makes about 94% of the contributions to this foundational web technology. If they sell Chrome, who fills that massive power vacuum? It could throw the future of web standards into chaos. As analysts at D.A. Davidson put it bluntly, we believe the only way forward for Alphabet is a complete breakup that would allow investors to own the business they actually want. Speaking of AI shaking up the giants, there's a much broader arms race heating up in an unexpected place. Global supply chains. Let's start with a single statistic that might just change your entire perspective on this industry. Spending on generative AI for supply chains is set to explode from $2.7 billion today to a staggering $55 billion by 2029. We're witnessing a full-blown AI arms race in the business world, It's not just startups. Established giants like SAP and Oracle are embedding AI deep into their systems, trying to leverage their massive customer data. At the same time, agile startups are attracting millions in funding by offering highly specialized, innovative AI solutions. This intense competition is what's fueling that explosive growth. You might think that with trade tariffs and global uncertainty, companies would be stockpiling goods to the rafters. But surprisingly, major manufacturers like the Toro company are doing the exact opposite, cutting their inventory back to pre-pandemic levels. So how are they pulling this off? They're unleashing AI as their new weapon. One supply chain manager now starts his day listening to a custom AI-generated podcast that digests everything from a former president's social media posts to global steel prices. His team uses AI to sift through an ocean of data, telling them exactly when and how many parts to buy from whom. Now, get this. The technology behind that AI podcast uses something called natural language generation to turn raw data into a coherent story. Then, text-to-speech engines make it sound like a human is reading it. But here's the critical part for handling volatile information. To avoid making costly mistakes, these systems often use a technique called retrieval augmented generation. That's a fancy way of saying the AI cross-references what it's saying against a library of verified, trusted data to make sure it's not just making things up. Tech giants like SAP, Oracle, and Microsoft are all racing to meet the demand, which consultants say is being fueled by tariff volatility. However, if you zoom out, you'll see another layer of complexity at play. One industry expert warns that while AI is a powerful enabler, it's, quote, not a silver bullet. She adds, I'm still looking forward to the day when AI can predict terrorist attacks at sea, for instance. And that expert raises a crucial point. Beyond just unpredictable events, there's a psychological trap that experts are worried about called automation bias. Believe it or not, when a complex AI presents a solution, there's a powerful human tendency to just hit accept without fully understanding the reasoning. Managers can become over-reliant on the system, which is dangerous because the AI's logic can be opaque or even flawed. This intense pressure all comes down to a battle for efficiency. Every component sitting on a shelf is capital tied up. A recent McKinsey survey shows the number of executives relying on big inventories to cushion disruptions was slashed from 60% down to just 34% last year. They're choosing AI-driven speed over physical stockpiles. And here's where it gets interesting. Because when these AI agents make decisions on their own, it opens up a huge legal and financial question. If an AI autonomously makes a multi-million-dollar mistake, who's to blame? Is it the software company that built the AI, the company that deployed it, or the human manager who was supposed to be overseeing it? The legal frameworks for this are still being figured out, and this uncertainty is a massive headache for businesses trying to navigate the future. When one top supply chain chief was asked if he's worried AI is coming for his job, his response was, I hope it doesn't take it until my kids get through college. That uncertainty is a massive headache for businesses. And speaking of uncertainty, the race to lead the world's most powerful central bank just got a massive shake-up. The most unexpected news in the finance world today has to be this. The odds for Jefferies chief market strategist David Zervos to become the next Fed chair just exploded on prediction markets. A relative unknown in the race, his probability surged to 15%, suddenly tying former frontrunner Kevin Warsh. Now, these prediction markets aren't just polls. They are regulated financial exchanges, like a stock market for news where people bet real money on whether an event will happen. The price of a contract reflects the crowd's collective belief, but this gamification of governance has a controversial side. Research shows that a single wealthy bettor could potentially manipulate these odds, creating a distorted picture of reality. This is where the situation takes a more complex turn. Sources are now revealing that Donald Trump is considering a staggering list of 11 candidates for the job. The pool is widening, with names like BlackRock's Chief Investment Officer for Global Fixed Income, Rick Rieder, now in the mix. The existence of these markets creates a powerful new incentive for strategic leaks from political insiders. Think about it. If you have non-public information like who's on a secret candidate list, you could potentially place a bet just before that information goes public. It raises serious ethical questions about who benefits and whether it undermines the integrity of the process. But the top spot is still held by Fed Governor Chris Waller, who sits at a commanding 31% probability. This entire search is a high-stakes battle over interest rates. Current Fed Chair Jerome Powell has been a frequent target of criticism for refusing to cut them. And Waller, the leading candidate to replace him, has already publicly dissented with the central bank. Back in July, he broke ranks on the decision to hold rates steady, calling the Fed's wait-and-see approach overly cautious. When we place the current data-dependent approach alongside the forecasting model that Waller seems open to, the contradiction becomes clear. The current method favoured by Powell is like driving by, looking mostly in the rearview mirror. You only react to what has already happened. It's cautious. The forecasting approach is more like using a GPS. It uses economic models to predict where the economy is going and tries to steer policy to get ahead of problems. The risk, of course, is that the forecast could be wrong. But for a team that wants faster action on rate cuts, a policy based on a prediction of lower inflation is far more attractive. What really brought this to a head is the risk to the Fed's independence. It was designed to be shielded from the short-term pressures of politics for a reason. When the Fed's leadership becomes a political football, it risks undermining the bank's credibility on the world stage. The long-term danger is that markets could lose faith in the dollar, leading to higher inflation and economic volatility for everyone. The question isn't just who will get the job, but how drastically they will pivot the direction of the entire US economy.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.